This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. A good trend following conversation today with somebody that I'm meeting for the first time, at least meeting on Zoom for the first time. My guest today is Richard Brennan. He is down under. He's in Australia. He's a trend following trader. He's got a really interesting story, interesting background. We kind of cover the gamut, going all around his life and back and forth and bouncing the ball across the net with me. So please join me for this conversation with Richard Brennan, who, by the way, was recommended by Jerry Parker. And you know what? If Jerry says, hey, Mike, you should probably have this guy in your show. He's interesting. I trust Jerry. Without any further delay, let's jump right into a little bit of trend following with Richard Brennan. I hope you enjoy. I don't know if I'll put this on the podcast. Depends on what you say. I've not been to Australia. I've flown over it on my way to New Zealand. And again, I'm not saying this in a mean way, but has there ever been a country that more people thought of more highly than Australia that has done its level-headed best to look terrible on the world stage in the last 1 year? I just can't imagine. I mean, it's Men at Work. It's Crocodile Dundee. No one has something bad to say about Australia. And in 1 year, travel plans, I'm not going there. What happened?
We've never followed the normative route. We've always been a bit out there, and a lot of people have always thought the Australian mentality, they're rebels, but that's not the reality. We do basically follow the rules in Australia. It's quite clear based on our response to COVID. But one of the things that does set us apart a bit from the rest of the world is that we cut losses short. What we were able to do, fortunately, at the commencement of the outbreak was we put a cap on it really hard, really fast. We didn't allow that tail event to emerge. We suppressed it immediately, created this safe realm in Australia where we watched the world enter this COVID pandemic and the associated issues and the build-up of this tail event in the world. And we were thinking to ourselves, gosh, how fortunate we are over here. But ultimately, it got to a point where we had to accept that we needed to emerge from this virus. We needed to accept entry in of this virus, but there was a lot of popularity across the states in Australia. The individual state politicians turned into little local overlords. Our federal system took a back seat while the states were basically controlling who could get into and out of the state. There was so much popularity expressed by those states that took a very aggressive stance to COVID, prevented people from coming in on the basis that they were protecting the public. A lot of people liked that, but that didn't allow us to enjoy certain freedoms a lot of the world didn't have over the course of the pandemic, because in Queensland, where I am, we might have only entered lockdowns a few times, but the majority of the time it was business as usual. But the people that were affected, of course, were those that were reliant on immigration or those that were reliant on tourism from interstate or international sources. So, of course, that side of the economy was hampered.
This policy that you're describing is not unlike Vietnam, not unlike other countries where the first year they kind of sealed the borders and said, hey, we're safe, and there was not a spread. And then the second year with Delta, it started spreading and the lockdowns didn't work. And then all of a sudden, when the lockdowns don't work and everyone has their, quote, come to Jesus moment, we're all going to get this thing. It's going to be endemic. We can't stop it. So all you can do is protect yourself, maybe get the vax, whatever one's got to do to protect themselves. But there is no way to seal the border on COVID. And I think what's happened now, and it seems like you're describing that, and again, I'm seeing it in other places too, is that these governments, they have that first year of success. They're like, oh, look at all the press clippings. And then the second year, none of those policies work at all. And now they just look like petty tyrants.
Exactly. There was this initial strong support for them, but as it wore on, you started to get this growing discontent. We needed to lock down, very slow to move. So they didn't recognise that this whole process was adaptive, and they assumed that their early stage controls were the way to go into the future. But I think they're paying the price now, Mike.
You slide in with the word adaptive, which I think is fair because that's where we're going to go a lot today, in the sense that adapting situations. You can't keep planning. These governments keep planning and people keep planning their finances, and they're going to figure it all out, and they're going to predict tomorrow, and tomorrow comes and it ain't like yesterday, and yesterday doesn't matter if it's gone, as Mick Jagger sang in Ruby Tuesday. So, I mean, here we are, right?
They're applying all of these predictive premises that you and I hate, these Gaussian premises. So at the moment, everything's contingent around this figure of 80% vaccination. The assumption is that the unvaccinated, unclean, unkept people evenly distributed throughout the population. But that's not actually the case. It might be 80% from a Gaussian statistic, but we get lots of pockets of this unvaccinated locales, which the problem's going to persist.
But the unvaccinated could have already had COVID and recovered and have a natural immunity that far exceeds the damn vax. Everyone wants to talk about the vaccinated, and I'm not saying you're doing this, but in the sense that what about the folks that have got natural immunity? It's like it's not even part of the equation. You're a data guy, so you're going to sit here like me and you're going to look at all these things, and I'm sure you just pull your hair out when you say, oh my gosh, we're tying one arm behind our back to look at these issues, and you can't do that.
Yeah, it's full of assumptions, and I'd like to see what these models are doing because it's quite clear that they're faulty. I believe they're based on these narrow assumptions, these homogeneous variables which are spread throughout. It's a real minefield, Mike.
First, you brought up adaptive. Now you brought up models in the sense of looking at COVID, which is a great way to think about this. I'm sure most people don't think that there are government officials with government doctors and a bunch of contractors being paid a lot of money to code up, because they've got the quote academic pedigree, to code up what they think they've been taught in school that will apply to this real world situation. And when it doesn't work, which is probably what's going on behind the scenes, what are they doing? They're just kind of doubling down, and they're refusing to say that our models are faulty.
You and I know we can't predict tomorrow, let alone next week. So all of these modelers are based on a faulty premise. We know that this whole COVID outbreak and the way it adapts and evolves, you've got to adopt a Bayesian sense of reasoning where as more data comes to light, you've got to adapt and change your strategies. But the assumption that these strategies are enduring and hard and fast and last for all time is nonsense to people that view things perhaps like you and I do.
Why do they not have any Bayesian thinking at all? I didn't grow up with the term even, but why do you think they don't have any Bayesian thinking at all? Why is it the Gaussian thinking? Why are they so flat-footed? And I'm not just speaking about Australia. It could be governments around the world.
I think it's a human condition, Mike. It's how we use our brain. I was reading a magnificent book by Lisa Feldman Barrett, 7 short lessons on the brain. She really knows her stuff. She's a neuroscientist who's been involved in understanding how the brain works, and her conclusions quite profoundly were that the brain's primary role is not to think, it's not to rationalize. The brain's primary role is to predict. So in the context of how we've evolved in this natural environment, that's been a very good strength for us. But all systems are not the same. So the system we might have evolved in is not necessarily the system that we find ourselves with COVID, or the system we find ourselves in trading these markets. And to put a predictive brain into those contexts, you're going to therefore necessarily have these faulty assumptions. You're going to be applying a recipe that might have been appropriate for a different system into a new system, and you're going to get this error. You're going to get this uncertainty. I think that's probably the problem faced everywhere. But everyone loves prediction because that's the way our brains think. But the reality is the system has the last laugh, and they don't necessarily like the term prediction.
I agree with everything you said. But as I get older, I start to think, well, you're being diplomatic in the sense that the people that want to go down the prediction path, are they just in error, or are they choosing a faulty path on purpose because the faulty path looks good to the unwashed masses, sounds good to the unwashed masses, and it allows people that choose a faulty prediction path to maintain power, to have control, and to make money?
Exactly, Mike. No one's going to appoint a politician on the basis of his uncertainty. The regulators are going to stand there in very certain terms saying exactly what they do. We will show you the way. We will show you the path. It's based on knowledge that you don't have, but we have. We're looking after you. And so that whole premise is sort of like a self-fulfilling prophecy, Mike.
Why do you have this perspective that allows you to analyze the world this way? Because we've not chatted before, and I'm curious, where does it start? Were you 13? Were you 15? Were you 17, 21? What's the kernel for why you have the thinking that you're describing to me? We're not even into trading or COVID right now. I'm taking you back in time. I want to know, what is the moment, the trigger, the something that happened to cause you to be a skeptic?
It's a bit of an Alan Watts story here, Mike. It was a process of exponential learning that occurred in an instant of time. So up until the point I was about 25, I led life according to the code of what my parents had taught me, the facts that I'd received. It was all there in my head, but it was very fragmented, disjointed. I didn't have an actual opinion on anything.
Did you trust it all, or are you just not sure?
No, I did. I trusted it. And yes, it did me well by the path that I was able to take with that level of trust. But the path obviously was a narrow path, and it certainly didn't have these spectacular outlier events that I now can appreciate. But it was a steady path. It was a path of mediocrity. It was a path of acceptance. And this is where your podcasts come in, Mike, in the way you challenge that with critical thought. So I didn't apply critical thinking.
Just a time frame this, you're in your mid-20s when you're starting to kind of wake up, so to speak?
Yes, I'd done a degree at uni in geology, and I'd always liked geology. So I naturally went into geology and came out the other end as what they call a soft rock sedimentologist, which is basically people with a degree of expertise in petroleum and oil exploration. But at that point in time that I came out in Australia, the industry as such was very highly towards the minerals, the mineralogy side, the gold, the nickel, that sort of stuff. So there weren't many opportunities open for people in soft rock sedimentology. So I spent 2 years just twiddling my fingers, hoping that opportunities would arise, went into the hospitality industry, made ice creams and sorbets.
I want to stop you for a second. You're the first person. I could be underexposed, but you're the first person who's ever told me, well, I wanted to go into geology. So you're going to have to tell me why exactly, because this is going to tell me something about you. No one's ever just said to me, you know what, I want to go into geology. Okay, a doctor, attorney, whatever. Geology, that looks good now. Gold mining, whatnot, etc. Oil, there's a money component there. But what was the motivation for you?
Motivation for me was to try and understand this concept called deep time. I always had a fascination with evolution. I always had a fascination with dinosaurs, a fascination with how carbon deposits form, how minerals form, looking at the course of geological time, which therefore made my mind much more expansive, eliminating the short-term view, looking at everything from the big picture. If I look back, that was probably one of these formative areas to look at things wider, more holistically than narrow and specialized. So this was my first chance at spreading across disciplines as opposed to investing heavily in a single discipline.
Before I interrupted you, you were talking about going into ice cream. You'd have to continue.
Right. I spent the time twiddling my thumbs, working in hospitality, making ice creams and sorbets for restaurants and things like that, working under a very good chef, excellent chef from France. And he basically taught me how to view cooking, to put some joy into the process, the joy of food, the joy of producing something good, the joy of quality. And that laid very good surrounds. But at that time, I was hanging around with a lot of drifters. And at that time, based on the fact that I hadn't achieved anything, there was this thing in the back of my head saying, you've got to achieve, you've got to achieve. But that was not being realized while I was working in restaurants, working in hospitality, etc.
Let me push you a little, because I think people are going to be thinking, well, where does the trend following fit in? I'm thinking of somebody who's become a good friend of mine, Larry Height, extremely eclectic background early on, but then he woke up and he made a pivot. First moment, trend following, when was it? Why did it happen?
I would say the moment came after a failure of predictive techniques for about 20 years.
So you were trying predictive models for 20 years on all kinds of things, and they weren't working. I had a guy on, Bill Dreiss, and Bill goes back in time, and he's looking at some of these early influences that he saw. Did you discover trend following entirely on your own? Was there some light bulb that you saw? Was there a mentor? Was there a book? What was the moment that woke you up?
It's so interesting you say Bill Dryce, because yes, he was definitely one of my mentors. So Bill Dryce, Jerry, of course, but Jerry came sort of later. I really got attached to Bill Dryce back in about 2013. He was pumping out these fantastic returns and I was clearly struggling.
So you were not aware of trend following at that moment?
Mike, I lived 20 years of my life spent basically in the shadow, not knowing that there was this trend following success story. And your books brought that to my attention.
Okay, I didn't know what you were going to say, but I'm still trying to press in the sense that I want to know the exact moment. You said my books. My books would have been, first one was 2004. So that was before Bill. I don't know when you saw it. But I still want to press you that when you had that first moment, and maybe it was Bill, maybe you're telling me that already, that first moment of this is trend following, I know what it is. For me, it was seeing in the 1990s what Jerry was doing with the turtles. So that was my first moment.
My real moment was seeing a validated track record, understanding a validated track record.
Another party's track record, somebody else's?
Yeah, so recognizing that there were firms. I'd been spending 20 years of my life since late 80s dabbling in lots of different techniques, actually working in the industry in areas of compliance. And under that realm of compliance, I had exposure to some of the investment programs that wanted to slot under our compliance framework. So in that context, I got to see what some of the investment fund managers were doing. But all of them were mostly value investors at that stage. But there were a couple that I saw in about 2012, these validated track records of 20, 30 years. Now, that picked my ears up.
Who would these have been, for example?
Dunn was one of the big boys that really attracted me.
If somebody has a pulse and they've never seen the Dunn track record, and then they see the Dunn track record, if their pulse doesn't quicken, they might be dead.
That's exactly right. This is what always grabbed me. We're not talking 5 years. We're not talking 10 years. We're
45?
Well, yes, and long may they ever live. I can't see it ending. So this is a track record of robustness and stellar return.
So for you, your process, and this is actually similar to mine, I was looking at the performance track records in the early to mid 90s. And so I'm looking through the old Stark report and I'm looking at these things and I'm seeing the correlation. Why are they all making money in March? Why are they all losing money in April? They're all making money in May and June. Then they're all losing money in July. What's going on here? Something's connected. They're not living in the same city. They don't know each other. What the hell's going on here?
Yeah, exactly. What's more stark to me is that when I read that Greg Zuckerman's book, he compiled this list of top traders. And of course, there was Jim Simon sitting at the top. There was Two Sigma. There were these other funds. Still, there was this lack of representation of trend followers. So I thought to myself, hold on. I know that a lot of these trend followers had better performance returns than Buffett. Why does Buffett appear in there, but we don't see these track records? So then went to the literature, looked at their track record, and lo and behold, I don't find just 1, 2, or 3 that we can classify as Jim Simons, Warren Buffett, or whatever. I find 30, 40 trend-following funds with a track record on a risk-adjusted basis that outperforms Buffett. And I'm thinking, is the industry ignoring them? What's happening? Why aren't they represented in the track record story? And that then opened this whole Pandora's box into how I see that this particular segment of the industry is being suppressed, notably by economic theory, which challenges this notion that trend followers actually exist on, this notion that markets are efficient. Well, that's not what a trend follower exists on. Trend followers exist on this market that is non-linear, has these moments of serial correlation or these spectacular exponential growth in trends. And this is the stuff that the dogma associated with economic tradition has suppressed. Of course, they don't want people to know that because it goes against the grain of what their whole premise of their theory, that markets are efficient and investors are rational. So lo and behold, that's how the story came.
Let me add 2 cents to the efficient market hypothesis, or whatever one wants to call it, theory. The longer I go on, I don't think they believe any of it. I really don't. I think it's all a power thing. And so the efficient market hypothesis has got plausible deniability. So people in power, in academia, in brokerage firms and banks and whatnot, they kind of hide under this thing because they can just say to their clients, the average guy who's got the money with them, we've got these Fama papers and he won a Nobel Prize and just be quiet. I don't think they'd even believe it. They just realize that if they allow kind of an open discourse to let the average consumer of financial products, to let that average consumer have the same aha moment that you had about the Dunn track record, they know they can't do that. So it's a power thing. I don't think they believe any of this shit.
No, exactly. They want us to believe in mediocrity. That's what they want us to believe in. So this whole sort of thrust is towards this notion that, hey, active fund managers out there, they rarely outperform the overall market. Markets are efficient. All investors can participate in what the market delivers, but they're failing to understand that who wants to go for mediocrity when you can go for superb.
That was your moment, though, is the track records. The track records were your light bulb moment. You were like, okay, this data is telling me something. You're already a little bit of a data guy. So this data is waking you up and going, oh, what's going on here?
It wasn't saying that these guys are successful. It was saying that 30 to 40 of them were successful, even more successful than maybe the handful that appear in the top fund managers of the world. So why is there this dominance of this particular style of investment program at the expense of all others? That tells me that there is superior models and inferior models. Trend following, therefore, stood out to me as a superior model. And then I had to understand why.
We're right back to the beginning where I'm bringing up the idea of COVID models. This all kind of ties together. The average person jumping in, maybe they don't see the connection, but it's all about a model. So let's get into the specifics, because you love to use the phrase complex adaptive system. I don't typically use it. I kind of know where you're coming from, but I guess I just kind of look at the world and assume all of what's behind it. But I'm going to let you get academic and explain it. But essentially, it's the world has got a lot of variables. There's a lot of stuff going on, and our ability to analyze it all to then make decisions using all of these inputs is just a tortuous, self-indulgent dream fantasy that we all have. How can we make decisions in light of all this conflicting information? What can we look at to make a decision? What can we grab onto to make a decision? And price data is pretty effective at that, isn't it?
It is, Mike. I think it's about this premise that the standard model, the Gaussian model, where everything is normally distributed, that's a very naive, simplistic model of how I view any system to behave. So when I examine systems, and I'm not just talking trend following here or finance, I'm talking any natural system. Any natural system that you investigate, when you dig down into the nuts and bolts of it, the things in that system disappear, and those things are replaced by process. When you start examining things scientifically and start narrowing your microscope to really investigate the nuts and bolts of how it all fits together, you come to this point where things just vaporize into a probability cloud. The things that we took for granted, such as the static things, they're not things at all. There are processes. The way I view systems is this interrelationship and interactions existing, systems within systems within systems within systems. And they're all moving. And no system is independent of another system. So that tells me that over time, systems change, they unfold, they adapt. There is no notion of static. And when I examine this notion of the word random, the more I get into it, I see that, well, randomness actually doesn't exist. It only exists when you're looking at a single system and you're looking at those variables in that system that don't have a correlated impact on that system itself, but they are important for external systems within which those systems are embedded. So they're not actually random, they are related to a different system. So the way I see this world unfolding, this dynamic interplay of cogs within cogs, is the way I see how all of it knits together into what I call a covariant universe. In other words, a non-random universe, a universe that makes sense. There's cause and effect in it. There is a path. Everything actually does have a place, but the way we analyze it when we reduce to this method of reductionism that we undertake with most of our scientific observations, we tend to put things into a closed laboratory under very specific circumstances where we can stand outside like gods looking into that system.
We try to control it.
We try to control it. Exactly. But what we've got to realize is we are participants in the system. We're not gods from outside looking in. Now, as soon as you are a participant in a system, you interact in that system and you have a role to play. There is an interrelationship between the behavior you have, between the behavior Mike has, the behavior Jerry has, the behavior all of these people have. All of this interplay creates these relationships or interdependencies. And when you get these correlated dependencies building, you get trends emerging. It's this positive feedback that exists in this system context of processes. And positive feedbacks is something that the world has ignored up until about the 1980s. And then in 1980s, we got an institute in the US called the Santa Fe Institute that started saying, hey, science, what you've done to date has been very important because you've reduced everything to the building blocks. However, what you're missing out on is the importance of the interrelationships between systems. Here is another way of presenting how markets behave. The likes of Brian Arthur come out with this notion that, hey, the economic models that traditionally were always based on an assumption of equilibrium. Things would oscillate around an equilibrium. And the story of equilibrium is a story of what I call path dependency. In other words, when you do a back test, a predictive modeler uses that history of that back test as a basis to predict how the future is going to unfold. It's based on one single path of history. It's a path dependency. However, the reality is that systems offer this path dependency to have a braided multiple path possible outcome dependent on what opportunities exist at one point in time versus what opportunities exist at another point in time. And what that means is you have a very winding path across many different possible histories to produce where we are in the now. And if you continue that forward into the future, you realize there is not one single path into the future. There is this braided view of this many possible paths of probability. Each one is determined by our decision and our choices at any particular path.
Let me add something in there, though, too, just for context so people can put an example to it. We brought up the Dunn track record. You're talking about many opportunities and, obviously things are constantly changing. Well, that means is that all the money that Dunn might make in year one might come from XYZ group of markets. In year two, it might come from an entirely different group of markets. And that's such a critical thing to understand for the average mind. And I'm not saying we're above average, but the average mind wants this consistency dream that doesn't exist.
I look at the story of the turtles. What would have happened if Jerry Parker hadn't responded to that ad in the Wall Street Journal? There wouldn't be a Jerry Parker today that we would probably be aware of. There was a very path-dependent process where these outliers existed in his history, fundamental points of change, which were transitional change. So this notion that there is no steady change, things happen in punctuated moments of massive change. Pivotal moments, Jerry responding to that ad, me stopping making ice creams. You can go through your history and see these pivotal moments. Now, these are all decision points. Path dependency really matters. And when I look at the track record of the trend followers and I see their path that their equity curves take, you see the impact of outliers in their history. Now, this is what really picked my interest up because these outliers are a manifestation of non-random, serially correlated events that really are life-altering. They're transitional events.
Put some context in there. For example, this could be the fall of 2008. A big event happens and all kinds of markets that don't look like they're connected start to do something unexpected. And if you have the wrong kind of model, you're not going to benefit. If you have the right kind of model, you're going to benefit.
Exactly. So the model is the key here. The constraints applied by the model is the key because the market itself holds the opportunity. The model is the way to extract that edge from that market. Now, buy and hold is not a model. It's just a let's invest now, close our eyes, and 30 years down the track, based on our assumption that economies always grow, I can leave that model with a profit. Along the way, you're going to have these major asymmetrical, nonlinear adverse moves, and you're going to have these major nonlinear beneficial positive moves. But the two will effectively neuter each other out, cancel each other out. So what that means is that they therefore get the benefit of the slow, boring change. They don't get the benefit of this leveraged, amplified, beneficial change that nonlinearity in our equity curves produce, because our systems demand that. We cut losses short, we let profits run, so we never stray too far towards the left tail of the distribution of returns. We're stunting them to produce a linear loss result, -1, -1, +1, -1, -1, +1. But we catch this occasional significant outlier, +20. And when you get that +20 added to that linear series, suddenly you get this massive amplification of returns. So in 2008, when we found that the markets actually were all correlated, all started going the same direction together, trend followers with their systems happened to be in that right direction, we doubled our returns, 100% in 2008. This wasn't the small change that we're used to today of 1% up, 1% down. This was a doubling associated with a non-linear market feature. But our systems were the things that extracted that edge from that market. And when I look at what is the real game changer in delivering returns in the long term, I used to read a lot of investment books, and one of the big ones was this principle of compounding. So we all know that when we compare a compounded series against an uncompounded series, you can see that compounding acts as a two-edged sword. It can either massively amplify returns if you've got this positive beneficial asymmetry in that uncorrelated underlying return stream, or it can exacerbate and produce this massive decline in wealth if you're asymmetrically inclined the wrong way. When I look at what trend following models do, which is superior to what other models do, I see this asymmetry in this model, which allows compounding to really magnify the results.
You've got a great way of really analyzing this at a very high level. Let's break it apart, though, so people can really wrap their arms around this. What's so cool about trend following, the models, is it's kind of like saying, we don't know what the hot opportunity will be this year. We don't know what the hot woman will be this year. We don't know anything what's going to be hot. But when hot appears, we want to get on with the hot. We want to be with the hot. And we don't know what's going to happen, but if we know the foundation that you've just described, this systems foundation, when the hot appears, built behind it is the idea that trends persist. And that's a really tough one for people, because they're looking at a market that's flatlining forever. And then all of a sudden there's this couple 100-day breakout. And people are like, well, why is that important? Well, it might only be important 40% of the time, but it's still, when you start to crunch it through the trend following model, it is important. Because again, how the hell can you figure out what's going to be the next hot thing unless you're taking chances to get on board? And when you take those chances, they're not all going to work out.
One of the big things is you hear people talk about, well, why was Warren Buffett so successful, or why was Soros so successful? They put it down to these key handful of major events.
For Buffett, Coke, Gillette, I mean, those are major events, right?
Exactly. I remember your podcast on Valiant Pharmaceuticals. If you were short during that period of that decline of Valiant Pharmaceuticals, you might be a very wealthy man now. So there are these moments in time where things go linear. They're non-random, but they go linear. And we've got to accept this because we see it in all systems. We see it in a fossil record. We see the evolution of life not being sort of gradually changing over the course of time. We get these periods of change interdispersed by these fantastic episodal events, what I call punctuated equilibrium. We get these massive change events which suddenly totally reshuffle that system and create a new niche for exploitation. So you need these periods of transition to disrupt the system to create greenfield opportunities that didn't exist before. And then you suddenly get an explosion of a new species, and then you get another change event, totally changing the direction. And ultimately, here we stand as human beings. But it's not that human beings are special. We're just the outcome of this path dependency of life and evolution over eons. And the same occurs with trend following. Trend following is based on the notion that systems change. If there was no change, there would be no trend. It's an inevitable consequence. We adopt this non-predictive philosophy, understanding that the nature of these systems is that way, that there will be these major change events. But we drop any form of prediction because a predictive method assumes an exact knowledge of how that future state's going to unfold. And we say, well, no, the major opportunities exist by you simply being present at a point in time with a system that's ready to turn on at that point in time. People are lucky. And when they say, what does it mean to be lucky? Well, it means you've got to be in the right place at the right time. So we say, yes, that is exactly right. But we apply a process to do that. To be in the right place at the right time means we must be diversified to be in the right place. And to be in the right time, we must have a systematic process that's turned on 24/7, might not be active, but is sitting there waiting to jump on any of these nonlinear opportunities. And then, therefore, you've got to be a participant in this process. So you've got to survive. So the key requirement is we must be like the robust cockroach that simply survives, but is present for these opportunities, and with their diversified systems and with their particular asymmetric system that's systematic, turned on all the time. It simply happens. We will be the beneficiaries. We will be the cockroaches.
I communicate with a lot of people. I know a lot of people, a lot of different voices. As I get older, I'm realizing that even for some people that I might be an ally with, friendly with, I have nothing bad to say about them personally. But at some stage of the game in the financial space, when you see people who base their careers off, I know what the Fed will do next. I believe this is the type of Fed policy that is great. I think rates will go up. I don't want to go get into a fight with folks over these issues. That's what they want to do, and that's what they want to spend their life doing. But there's a side of me that does want to fight. There's a side of me that does want to just say, oh, come on, shut the hell up. That's complete nonsense. You know it. I think so many people have figured out a way, and somebody could say this arguably about me or you, so many people have figured out a way to participate in the financial world. And the ways that they might figure it out might make them a lot of money. But the foundation on so many of these philosophies and things that people say is just 100% nonsense. They don't have any insight at all. They literally write books dreaming up these philosophies. They understand the arcane. They can piece it all together. They're just brilliant. And they might be brilliant if you're measuring them in terms of IQ, but their philosophy is just horseshit. And it doesn't make any sense. We're in the middle of this odd circumstance now where we're all connected and everyone's got something to say. But most people, when it comes to finance, money, etc., what they have to say is not useful at all.
Totally agree, Mike. It tends to be from the mindset of youth, where you believe you have the power, you're in control. And I think as we age and as we become more experienced and understand things in a much wider context, we realize the hopeless futility of that whole premise, that argument. And when I see your podcast, where I get a wealth of information from, I see you drawing from the minds of the best in the world across vast different disciplines. What that does to Mike Coveil is rewiring his neurons to remove this thought of control or your ability to control, but it's increasing your ability to appreciate, and it's increasing your ability to recognize that we are just agents in this majestic system called life. There are ways to live a better life. It's not a fair world. It's an asymmetric world. There are better decisions than others. These are things that we reach at the tail end of our lives when we realize the stuff that you hear in the mainstream, that's noise to me. I avoid that conversation. It's not adding anything to me as a person, to me in connecting those light bulbs up, making it all make sense.
I'm sure you feel this way too. I'm lucky in the sense that I bumped into a particular style of thinking, philosophy about the markets, about investing, about trading, and that I didn't realize at the time how much this would correspond with the way that I was probably going to think about life already. Meaning I might not have ever heard of trend following, but I would have already gone in this kind of direction, maybe the way you were describing yourself. And I'm sure a guy like Jerry Parker, he had the same kind of realization earlier than you and I, where he kind of was like, wow, I already had this way of being, this way of thinking. And then somebody shows me this way to deal with the markets and money and trading. It all dovetails together. And for all of us, it's not like we're sitting around saying, oh, we're the smartest guys. We're just lucky in the sense that we don't have to pretend that we're making something up. We're just kind of looking at, here's what it is, here's what to do, and that's it. You're not trying to make some fancy salad. It is what it is.
There's a good scene at the end of Saving Private Ryan where he's at the cemetery overlooking his friends who didn't make it during the war, and he's thanking them for giving them the legacy that he now stands upon. And I think that's how I accept life now. I recognize that what you hear from me as Richard now is really me as Jerry, me as Tom Basso, me as all of the people that have been influential on changing the way I think. I recognize that all of that has actually not been through my own efforts. It's been through understanding vast different perspectives. And the more you pluralize these perspectives, the more you come to understand a much more Eastern way of considering life. The whole thing about Western democracy, the whole thing about the Western religion, you clearly see it's about control. It's about the autocratic religions, we're controlling you. But when you get into understanding more about the Eastern religions, it's not about control at all. It's about empowerment. It's about this strive for illumination to understand the connections that exist, which empowers you. And I think that whilst I'm not a spiritual type of person, I think ultimately as my life ages and I'm drawing on more and more of these experiences and different perspectives, I think I have a much grander appreciation of how it all connects than someone who's gone down that control path because they're privy to only a specialized, narrow scope. They've missed out on this wonderful thing called life that exists outside of that. And I think this philosophy of trend following is a culmination of that because it's far wider than just a trading technique. It's a way to live your life, to go with the flow, to acceptance. It's not about control. It's about taking the opportunities that are presented to you, that stand out to you. But you won't see those opportunities if you adopt this controlling mindset.
That could be like my obituary for how I ended up in Vietnam. I mean, I think you just described it to a T.
Could be. I think Spike Milligan had one of the best obituaries on his gravestone. He said, see, I told you I was sick. We're going to have some corny statement, a bit of an Ed Seykota riddle on our gravestones to say, hey, we were trend followers.
You brought up Ed Seykota. You brought up Tom and Jerry, and I'm thinking of Richard Dennis and his influence on Jerry. Here I am in a Buddhist country at the moment. And you brought up Alan Watts earlier. If one looks at these Wall Street precepts that people really love, Ed Seykota's comes to mind. Everyone gets what they want out of the markets. If you lose all the time, you were getting what you wanted, something like that. I lay this out, and you bring up this Zen connection. Most of these great Wall Street precepts that we love, it's all Zen. None of it is control-based. The stuff that we love, the stuff that people quote, the stuff that Buffett says, the stuff that Soros says, the stuff that everyone says, all the names that I just mentioned, it's all Zen. And I'm not saying they swiped it or they paraphrased it back to Picasso. Everybody's stealing a little bit everywhere. How do you make it into something fresh? But really, when it comes to these great Wall Street precepts about money, investing, finance, etc., it's all Zen. The Buddhist guys had it figured out.
Definitely. It's amazing the paths we weave. I took a journey from science that ultimately took me into trend following. I had a very strong interest in the likes of Richard Feynman, David Bohm, an amazing physicist who started looking at thought as a system. All of these different physicists, Einstein, they were all Zen. They understood this broader picture. And then they undertook their hypothesis to basically explain a component of their Zen. And lo and behold, it works out. This totally changes this domain from one of certainty to one of uncertainty. Up to the 1900s, everything was predictive modeling. Everything was based on Newton's principles of, we know in a clockwork universe how everything's going to unfold. Einstein challenged that because Einstein listened to Mach as a philosopher. So the philosophers were infiltrating the way he thought, and that challenged this whole notion of what Newton had, and he totally revolutionized the landscape of mechanics. Really, the change was small, but it had huge consequences. The whole nature of the realm that mechanics operated in was so different to what Newton had predicted, this fixed domain where things happen predictively. Now we have this dynamic domain where space moves and undulates and energy gets redistributed and reconcentrated. This is how our life goes, Mike. We have these transformative moments. It might be a small change, but it has magnificent effects on how we view our prior thought processes. We get this domain shift, a transformation that suddenly explodes the way we think with new opportunities. New light bulbs start flickering.
I still remember asking, I think it was on a second or third edition, I remember asking Bill Dunn if I could use his bucking bronco quote on the front cover, just a quote that was in the book, but I was like, that so sums it up. We're not making predictions, we're just riding the bucking bronco. It's such a lovely way because it's so visceral. Everyone gets it. You're riding the bucking bronco. Okay, I can imagine that. I can see the bucking bronco. I can see you on it. I can see you holding on. And sucker's bucking, trying to kick you off. Hold on, you're not trying to control the bull. You're just riding it. You can't control the bull. I'm trying to control the bull my whole life. That doesn't work so well. I don't make market predictions. I just ride the bucking bronco. Literally, those handful of words from Bill Dunn are more valuable than 99% of the 300-page investment books than you could find on Amazon. Those handful of words. I don't make market predictions. I just ride the bucking bronco. Just take that, put it on the wall, and throw everything else out.
It's the same as the old David Ricardo statement. The mantra I live by, cut losses short, let profits run. Incredibly powerful.
Hard to do, though.
Absolutely. But it's a bit like being delivered an alien technology that just works. You don't have to understand how it works. Just apply it. When I see these statements of life that people come up with, you realize that it's incredibly nuanced what they say. It might be a simplistic statement, or it might be an Ed Seykota statement that has you sort of thinking it's a Zen riddle. But deep within that is a highly nuanced expression that connects so many goddamn things. It should not be taken lightly. People might find it hard to understand Jerry because he certainly doesn't think like the classic sort of quant in a tie and suit when he explains things. I love the way Jerry speaks because I tend to interrogate everything he says, understanding what the nuances are in what Jerry says, because when I unpack that, I get this wealth of knowledge suddenly being transferred to me by something flippant that Jerry might have said in a short statement. It's a bit like he throws out this complex mathematical formula in this very concise way that is ridden with, laced with information, and it's up to you to unpack it. And really, it's got to be you because that's the only way you're going to accept it and understand it.
What I think with Jerry, which is really interesting, is to think about his career from where he started. So he starts on this, quote, level playing field with the, quote, other turtles. Let's say there was approximately 20. The experiment ends. They all go off and do their own thing. Jerry ends up doing the best, but quite a few others did really well. Paul Raybar, Tom Shanks, Liz Cheval, several did well. But what's really interesting is the divergence that Jerry took, meaning you don't have to understand alien technology to use it, but you got to have some semblance of it because there's clearly something that a guy like Jerry brought to the table that other folks did not bring to the table. Now, in all fairness, for example, Liz Cheval passed on suddenly. She might have continued to have a fantastic career. She had a great career. But Jerry has survived and he has prospered. And it does seem like, and I thought this early on, because I spent a lot of time analyzing these individuals and I talked to a lot of these individuals. And let me tell you, as smart as Jerry is, as practical as Jerry is, as down to earth as Jerry is, a couple of the folks that he was in class with, and I don't know if he would say this, but I would say this because I've got their recorded interviews, they were sort of nuts. So Jerry was not anywhere close to nuts, but some of these folks were out there. And that gets back to the genius of Richard Dennis in the sense that he kind of did this experiment and he proved a lot of things with that experiment. I wrote a book about it, but I think Jerry's got something that not all of the other turtles necessarily had. And maybe some people don't want to hear that. Maybe some people want to say, oh no, we were all equal. I'm not buying it.
Yeah, I think Jerry embraced it. There was something in Jerry that made him automatically fall in love with it. He often says when he was presented with the ideas of Richard, It was just something that he thought was the best thing in the world. And to have that immediate appreciation of something tells me that he's already pre-aligned to accepting it. And a system that is Jerry is configured in the correct way to bring on board this and apply it. Actually, interestingly, I found out that Jerry had a bit of an acting career as well. Did you know about that?
I did not know about the acting career. Okay.
All right. So have a look at Me, Myself, Irene with Jim Carrey.
Oh, I remember that. Okay. I thought you were talking about something before the Turtles or something. Okay.
There's many facets to Jerry. You might think it's all about trend following, but there are many shades to Jerry, which I love.
Let me bring up something as we wind down, just kind of something I wrote down that I wanted to bring up. And I think it dovetails well with your start in analyzing and going down the trend following path, which is looking at performance data. I sometimes joke with some of the practitioners in this world that a lot of these other names for trend following were invented because if they started using trend following, they would all end up going to the guy who owns trendfollowing.com, which is me. So we came up with time series analysis and all these other things, some of the things before trend following, CTA and managed futures and all these things that people want to use. And momentum. So that's probably the newest way to not use the phrase trend following. So they didn't talk about momentum trading. It gets described as, okay, finally the academics have come on board and said, oh yes, we now believe in momentum trading. We can now see that it works. They still haven't even looked at the track record of Bill Dunn, but they now know momentum trading works. They came up with two types of momentum. Of course, they renamed these suckers something new too. Time series momentum and cross-sectional momentum. And the cross-sectional would be the relative strength, and trend following would be time series analysis. Now, these are two entirely different damn things. They are not the same thing at all. Academia will tell you, oh no, we figured out momentum, we know it now, and there's two forms. The skeptical person would say, okay, fair enough, academia. Now I'm back over here on the time series side, and I can see, well, there's a Jerry Parker, there's an Ed Seykota, there's a Bill Dunn, there's a John Henry, there's a whole list, there's Mann, there's Winton, there's all these people over here. On the time series side, okay, that looks like a validation. We've got something there. That looks like it's interesting. We should investigate further. And then I look over on the other side of momentum that academia invented, and I say, where is it? Where are all the track records? To this day, where are the freaking cross-sectional relative strength track records? The same as the ones I just described. Do they exist? I've not seen them yet.
And that's what I've found as well. I scour the performance track records and I produce these monthly track records of fund managers, particularly focusing on the CTAs, because they have the demonstrated long-term track records. There's the survivors with a strong performance record. I'm not finding any examples of cross-sectional momentum in the 30, 40-year track record. Now, this is not to say...
There could be somebody out there doing it, yes. We're not saying that.
There could be, but we're not finding 30 to 40 to 50 of them. We're finding a few rare examples, a bit like the Buffett story and a bit like the Jim Simon story. We're not seeing a whole collection. When I look at cross-sectional momentum methods, I think to myself, oh, what a shame they're doing that, because what they're doing in their premise is they're adopting, once more, a predictive mindset with the assumption that something that has expressed recent outperformance in the past is going to continue on into the future. And I think to myself, why? The whole trend following mantra is to follow price, not to predict it. Now you're telling me that we've got a method that people often do confuse with trend following, because I know some of these cross-sectional methods to sneak into our trend following lexicon. They're not the same. They're different beasts. I think really this huge edge that we've got over them is that they're almost going down this convergent predictive premise to try and squeeze out opportunities in these more regulated regimes of 2010 on, where quantitative easing has been suppressing the markets. And yes, they might have been successful over the last 10 years, but...
It's mostly theory, though.
Yeah, it's theory. And there'll be a few academic papers. I know that Gary Antonacci has demonstrated the academic papers that do support it, but it's an inferior edge. That's the thing, Mike.
It's presented as an equal thing. That's what bothers me.
Yeah, there are no trade-offs in this world. It's an asymmetrical world. There are some methods that are better than others. A lot of people get annoyed with me because they think I'm a fanatic in relation to trend following when I just say that it's a superior approach. Now, I don't mean to denigrate these other methods, but I just know from the performance track record that it is a superior approach. Show me a 30-year track record and this superb risk-adjusted return performance. I'm more than willing to accept that I'm wrong.
I think many people that listen to my podcast, they'll know where we're going as we're talking about these track records, but we're talking about basically professional trend following track records and the education you can get by looking at the monthly returns. It's just a tremendous thing for people to go examine. It's out of this world, what you can learn.
I remember clearly in one of your videos where you step through Dunn's performance month by month using a monthly performance table. The first thing you do is you present this equity curve and you say, who wants this? And everyone goes, yes, I want this. And then you say, but look what you've got to do to achieve this. And you step through the month by month. You see these protracted periods of underperformance, but then you'll occasionally see this bright, glowing spot of outperformance. And this asymmetry in that series, these bright spots, more than pay. It's the Ed Secoda whipsaw song. These trends pay for them all and then some. So when you get these outliers, these nonlinear beneficial features, forget your drawdowns. A drawdown is a necessary expression to get the returns we get. Volatility does not equal risk. It's path dependent. These opportunities of transitions are spectacular moments that none of us can predict. You just got to be there. You've got to have your systems triggered and you've got to be trading them and jump on board.
When I just brought that up a second ago and I interrupted you and I brought up the idea of looking at the performance again, there was a thought that I had the brain fart on that I forgot that I really wanted to push on, which is the idea that when one looks at these performance track records, now, this doesn't necessarily help the investor that's going to invest with these individuals. It could give inspiration to people that want to do it on their own. But when you look at that Dunn performance or any of the professional trend following performances, they're capitalists. So they hold their services out and they get a fee. So when you're looking at those performance track records of trend following, for example, the Dunn 45 years, when you're looking at that, that is after their fees. So we're talking about amazing performance that's after fees. So if one just wants to look at this purely on the philosophy, the theoretical part of how much money, independent of the managed money industry, independent of traders getting the pay that they say they want for their services, independent of all that, if one just looks at adding back in the fees to the performance track records that you've brought up, talking about going back decades, it's a hell of a lot more money than people are really thinking about.
Net asset value after fees and expenses. That's right.
I've always thought that's an amazing side part of all this. Richard, very cool. I'm happy to chat with you. I hope you didn't think I was crazy when you were laying some of that early backstory, but I knew I wanted to let that mind get into trend following. I wanted you to get there and get into it and roll with it. And I think you did a really good job of that.
Thanks, Mike.
So listen, where can we send people? Where would you like to direct them to? I know you've got a bunch of podcasts you've done out there also with Top Traders Unplugged, and people can find those. I've not listened to any of those, so I don't know. Was I more normal or less normal than Niels?
Just different approaches. Loved your method.
Do I have an approach? I like to think of myself as just being adaptive. Whatever you're going to give me, I'm trying to go there.
You dig under the covers. You bring out some interesting new thing that might not have been heard before. So you burrow into it. I love your interview technique.
Fun stuff, fun stuff. Hey, where can we send people though? Where would you like to direct them?
The website, atstrading-solutions.com, and Twitter, my handles at richb118. They're probably the two most dominant areas you can catch me.
Cool stuff, man. I thank you for coming on. We'll get everything up and get it live.
Thanks very much, Mike. A real pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.